Keep your eyes glued to the monitor because what you are witnessing is a historical anomaly. The value of silver didn't just climb today, it underwent a literal teleportation. We are observing a marketplace that shifted by a staggering $6 in a solitary trading period. Currently, the price is hovering at $78.83, marking a massive surge of 8.25% in only 24 hours. If you have been searching for a definitive green light to enter this market, you're looking at it right now. This is far from your typical market rally. For several weeks, we have cautioned that Western valuations were far too low. We pointed out that New York was offering silver at a massive discount compared to the rest of the globe. And today, that tension finally caused the market to snap. The American price is now in a frantic race to catch up with global benchmarks. Yet even after this explosive move, we remain in the shadow of international prices. Fresh statistics have just arrived from the Shanghai Gold Exchange. While traders in New York are stunned by the move to $78, silver in China is already changing hands at $83.98. A significant $5 discrepancy still exists. That international price acts like a giant magnet continuing to drag our local prices upward. In this urgent market update, we are going to perform a deep dive surgery on this vertical price action. We will clarify why automated arbitrage algorithms are snatching up every available contract to bridge the gap with the Chinese market. We are also going to examine the massive short squeeze that is currently wiping out the banking institutions that attempted to suppress prices last week. Furthermore, we will explain why 70 might actually be the most affordable price point you will see for silver for the remainder of the calendar year. The structural dam has failed, the floodwaters are rising, and the major banks are currently submerged. This is the chronicle of the $6 candle. To grasp why the silver market surged by $6 today, you have to comprehend the fundamental physics of a market vacuum. In a typical, healthy liquid market, you find sellers at every incremental price point. There are people willing to sell at 73, others at 74, and more at 75. The price usually has to work its way through these various layers of sell orders to move upward. It is a slow, methodical grind. However, today, those sellers were nowhere to be found. The ask side of the order ledger was completely vacant. The major bullion banks, which typically sell short to keep a lid on prices, decided to step out of the way. Why did they move? Because they are absolutely petrified of the prices being quoted in Shanghai. They realize that if they sell silver for $75 in New York, they are essentially handing out free profit to anyone capable of transporting that metal to China for $84. Consequently, these banks withdrew their sell orders. When the big buyers entered the fray, including pension funds and industrial hedgers, they stepped into an empty room. They executed market buy orders, and because there were no sellers in the middle, the price simply leaped from 73 to 75 and then straight to 78. It encountered zero friction. This is the phenomenon of teleportation. It serves as evidence that the float, or the actual metal available for immediate trade, has effectively evaporated. We have entered a phase where the price must jump huge gaps just to locate a single ounce of available liquidity. This level of volatility isn't a malfunction. It is a core characteristic of a severe shortage. When you run out of physical inventory to act as a buffer, the price itself becomes the only way to absorb the shock. Let's focus on the ultimate target, 83 as 98s. That is the going rate for silver in China at this very moment. Throughout the past week, we have observed the New York market trailing behind like a laggard. When New York was at 72, China was already at 80. When New York hit 75, China moved to 82. The global economy cannot maintain two vastly different prices for the exact same commodity indefinitely. That would violate the law of one price. Arbitrage traders, who are among the most aggressive players in finance, are currently forcing these two disparate numbers to meet. They are aggressively buying up the undervalued New York contracts and simultaneously selling the premium Shanghai contracts. This buying pressure in the United States is absolutely relentless. It doesn't care about your chart patterns or technical indicators. It doesn't care if the relative strength index, RSI, suggests the market is overbought. These traders only care about the price spread. As long as New York remains a bargain compared to Shanghai, the buying will persist. Even with silver at $78, New York is still trailing by $5. This indicates quite clearly that the rally has not reached its conclusion. The arbitrage vacuum remains wide open, and the pressure is still in the process of equalizing. We are currently watching the US dollar price being forcibly pulled up by the Chinese yuan price. The power to set prices has migrated to the east, and the west is being dragged along whether it likes it or not. Now take a moment to consider the plight of the short sellers. Visualize a hedge fund that took a short position against silver last week at $75, betting that the price would hit a ceiling. This morning, they woke up to a catastrophic $6 loss on every single contract. On a standard futures contract, that equates to a $30,000 hit per unit. If that fund held 100 contracts, they effectively lost $3 million before they even had their morning coffee. This level of loss triggers a forced liquidation. The risk management department at the brokerage firm takes control of the account. They don't consult the trader. They simply execute buy orders to close the position. They buy at 76, they buy at 77, and they buy at 78. These buyers are price inelastic, meaning they don't care about the cost. They just have to get out immediately. This forced short covering serves as high-octane rocket fuel. It is pure panic buying hitting a market that already has no willing sellers. This generates a dangerous feedback loop. As the price climbs, more shorts are liquidated, and as they are liquidated, their buying drives the price even higher. We are currently in the center of a simultaneous gamma squeeze and short squeeze. It is a perfect storm of financial agony for anyone betting against the metal. You might assume that at a price of $78, the physical supply would start to loosen up. You might expect retail dealers to lower their premiums to move more volume, but that isn't happening. We are monitoring the dealer inventories in real time, and premiums are either staying flat or actually increasing. The reason is simple. The dealers are watching the Shanghai price just like we are. They recognize that $78 is still a bargain price. They are not going to sell you a silver eagle for $80 when they know it will cost them $85 to replace that coin in the global wholesale market. Therefore, the physical lockout continues. This proves that the current rally is legitimate. If this were merely a fake rally driven by paper trading, the physical price would be lagging behind. Instead, the physical price is leading the way. The street price is confirming that the screen price is real. This isn't a speculative bubble. It is a fundamental re-rating. The market is finally waking up to the fact that $70 was the wrong valuation for a rare, strategically vital metal. Finally, look at the sheer volume of trades. Today's movement didn't happen on low activity. It happened on massive institutional volume. Billions of dollars have traded hands today. This shows us that the smart money is fully involved. This isn't just a handful of small retail investors chasing a chart. This is the work of pension funds, major banks, and industrial giants. When a price surges on high volume, it is a sign of deep conviction. The buyers are all in. They are stepping up at $76, $77, and $78, establishing a brand new floor for the market. The wall of worry has been scaled, and now we are accelerating across the plateau. The vacuum is open, the short sellers are defeated, and the East is in the driver's seat. However, silver is not the only player making moves. There is another massive signal blinking red on the financial dashboard, a signal that indicates this is about more than just silver's supply and demand. It involves the very foundation of the global financial system, gold. Gold just made a move that is statistically even rarer than silver's spike. It has surged by $135, or 3% in a single day. For the world's primary reserve asset, that is nothing short of a monetary earthquake. In the following segment, we will analyze this gold signal. We will explain why a 3% daily jump in gold signifies a major systemic failure. We are going to look at the crumbling debt markets and the geopolitical catalysts that are forcing capital into safe havens. We will also explain why silver is behaving like gold on steroids. The king has moved and the knight is following close behind. We are witnessing the checkmate of the fiat currency regime. We need to divert our attention from the silver charts for a moment to observe the broader horizon. What happened to gold today is actually more statistically significant than the silver spike. Silver is naturally volatile and can move 8% with some frequency, but gold is the anchor of the $15 trillion global financial system. It usually moves with the speed of a glacier until today. Gold is currently trading at 4,467, having climbed $135 in a single session. That is a 3% jump. To provide some context, a 3% move in gold is the mathematical equivalent of the Dow Jones Industrial Average, dropping or gaining 1,500 points in a single day. This is a black swan event. These moves don't happen during ordinary times. They happen during the invasion of a country, the collapse of a major bank like Silicon Valley Bank, or the 2008 global financial crisis. When gold moves 3%, it is the market's way of screaming that something in the plumbing of the financial system is broken. It is a distress signal for the entire system. The big players, central banks and sovereign wealth funds, are ditching the dollar and the bond market to pile into the only asset that carries no counterparty risk. This provides absolute validation for the silver rally. Silver isn't going up because of some social media hype or a Reddit squeeze. It is rising because the entire global monetary order is being revalued. Silver is simply caught in the slipstream of the king, and when the king begins to run, the prince begins to sprint. This leads us to the financial concept of high beta. In the world of investing, beta measures how much an asset moves in relation to a specific benchmark. Historically, silver acts like gold on steroids. It typically has a beta of 2 or 3 against gold. If gold moves up 1%, silver usually moves 2% or 3%. Today, gold moved up 3% and silver moved up 8%. The mathematics are perfectly consistent. This is precisely how a healthy, robust precious metals bull market is supposed to function. This correlation acts as your safety net. If silver was up 8% while gold stayed flat, I would tell you to be extremely cautious, as that would look like a speculative bubble. But because gold is leading this charge with a historic, systemic move, silver's surge is entirely justified and foundational. The world is repricing tangible, hard assets against depreciating fiat currencies. Gold is doing the heavy lifting, and silver is simply reaping the benefits of the overflow. The sheer volume of capital fleeing the US dollar is becoming too massive for the gold market to contain, so it is spilling over into silver. Because the silver market is tiny by comparison, that spillover creates a total tsunami. We must ask, why is this happening today? Why did gold rip $135 higher on a random Tuesday in January? We are aware of the headlines regarding Venezuela, but typically, geopolitical news causes a brief spike that fades within an hour. This rally did not fade. It gained momentum as the trading day progressed. This suggests that geopolitical danger is transforming into a full-blown financial crisis. The market is detecting a major fracture in the bond market or a looming disaster in the banking sector. When gold climbs this rapidly, it usually indicates that a massive financial institution is in jeopardy or a major national currency is on the verge of devaluation. We are seeing evidence of insider buying. Someone knows a truth that hasn't reached the mainstream news cycle yet. Perhaps a central bank is preparing to liquidate its U.S. Treasury holdings, or maybe the conflict in South America is about to escalate. We don't have the specific headline yet, but the price is the news. The price is telling us that the demand for safety has suddenly become astronomical. Silver is the poor man's safe haven. When gold becomes too expensive for the general public, they switch to silver. At $4,400, gold is becoming inaccessible for the average person, but at $78, silver still feels reachable. This substitution effect pushes silver even higher as gold transitions into a luxury reserve asset. Let's look at the gold to silver ratio. At the start of this week, the ratio was near 60. Today, with gold at $4,167 and silver at $78.83, that ratio has compressed to roughly 56. This means silver is now outperforming gold. Historically, during the mania phase of a bull market, this ratio tends to collapse. It drops to 40, then 30, and sometimes as low as 15. We are still at 56, which tells us that despite this massive 8% rally, silver is still incredibly undervalued compared to gold. It hasn't even reached its historical average valuation yet. If the ratio were to return to the 2011 lows of 30 to 1, while gold stayed at its current price, silver would be worth $148. This is precisely why the automated trading algorithms keep buying. They are playing the ratio trade. They sell overvalued gold to buy undervalued silver to close that gap. As long as gold stays strong, the floor beneath silver continues to rise. Mathematically, gold is the shield and silver is the sword. We also have to analyze the macroeconomic calendar. The U.S. debt ceiling deadline is looming in the first quarter, and the Treasury is running out of liquidity. The bond market is becoming increasingly jittery. A 3% jump in gold is often a vote of no confidence in the government, its ability to settle its debts without printing more money. The market is starting to price in fiscal dominance. This is the economic theory, stating that a central bank is eventually forced to print money simply to keep the government funded. When fiscal dominance takes hold, fiat currency loses its purchasing power at a rapid pace, and hard assets re-rate toward infinity against the failing currency. We are watching the global market realize that the debt spiral has become terminal. There is no escape route remaining except through inflation. If you know that massive inflation is coming, you buy gold and silver right now at any price available. That is the panic we witnessed today. It wasn't speculation. It was a mass exodus from the US dollar. So the monetary system is trembling, gold is soaring, and the banks are scrambling to cover their positions. But what about the industrial world? What about the factories and the people who actually require silver to manufacture goods? In part 3, we are going to shift our focus back to the real economy. We are going to examine the industrial panic that this price surge is triggering. If you run a solar panel company and your raw material costs just jumped 8% in 24 hours, you are in a state of terror. You are about to engage in panic buying to secure inventory before it rises another 8% tomorrow. We will look at the inelastic demand curve in the retail dealer market where premiums are climbing despite the higher spot price. This proves the physical shortage is worsening, not improving. The paper price is high, but the physical metal is simply gone. Stay tuned, because we are heading into the supply chain. We have spent the last hour discussing financial fireworks and short seller liquidations. We've heard gold's warning to the world's central banks. But financial markets are merely a reflection of the physical world. In the actual world, on the factory floors of South Korea, China, and the United States, a much grimmer kind of panic is taking root. It is one thing for a trader to miss a move on a computer screen. It only cost him some profit. It is a completely different crisis for a factory supervisor to miss a shipment of silver. It could cost him his entire company. Today, with silver's $6 explosion, the global supply chain just suffered a major cardiac event. In part 3, we are leaving the trading pits to head to the industrial front lines. We will explain why massive corporations like Samsung and Tesla are currently engaging in desperate panic hoarding. We will break down why the price of silver could reach $100, and the industry would actually buy more of it, not less. We will also look at the dealer freeze currently happening in the American retail market. If you think it is difficult to buy a futures contract, try finding a monster box of silver eagles today. The screen says $78, but the physical shelves are empty. Let's analyze the shortage. I want you to put yourself in the shoes of the chief procurement officer for a major solar energy firm. Your facility manufactures millions of dollars worth of panels every day. To create those panels, you absolutely require silver paste. Silver might only represent 5% or 10% of your total production cost. Yesterday, silver was $72. Today, it is $78. Does this price hike cause you to stop your purchases? Absolutely not. If you stop buying silver, you cannot finish your solar panels. If you can't finish the panels, you can't sell them. You would lose 100% of your revenue just because you were trying to save 5% on a raw material cost. This is the definition of price inelasticity. Industrial buyers are not sensitive to the price. They are sensitive to the availability of the material. When the price jumps $6 in a day, the procurement officer doesn't think the metal is too expensive. He thinks there's a shortage and he needs to stockpile as much as possible before it disappears. Thus, the price spike actually creates more demand. We are seeing reports of industrial entities doubling their orders today. They are abandoning just-in-time delivery in favor of just-in-case hoarding. They are draining the global supply chain to build a protective buffer. This is the inventory supercycle, and it transforms a price spike into a self-reinforcing price spiral. Now, let's look at the bullion dealers, the businesses that sell silver to people like you and me. Today was a total catastrophe for companies like APMEX, SD Bullion, and JM Bullion. Imagine you are a dealer holding 10,000 ounces of silver that you acquired at $70. Suddenly, the spot price rocketed to $78. You should be thrilled, right? Not necessarily. You have a massive replacement problem. If you sell that silver to a customer today for $79, you have to go back into the wholesale market to restock. But that wholesale market is currently in chaos. Refiners are hiking prices, and the Shanghai market is vacuuming up all available inventory. What if, by the time you go to restock tomorrow, the price has moved to $85? You would have effectively sold your inventory at a loss relative to what it costs to replace it. You would be selling gold to buy lead. So what do dealers do in a vertical market? They widen their spreads and hike their premiums. The spot price might be $78.83, but if you visit a website right now, the price for a single silver eagle is likely $95 or more. In many cases, they simply list items as out of stock or call for pricing. They are freezing sales to shield themselves from the extreme volatility. This creates a physical lockout. The computer screen tells you silver is $78, but you cannot actually trade your paper dollars for metal at that price. The real price to get physical metal in your hand is rapidly closing in on $100. The paper market is currently lagging behind physical reality by at least $20. We also have to discuss the mining sector. At $78 per ounce, primary silver miners are generating levels of cash flow that rival the biggest tech companies. Their operational costs are mostly fixed. They pay for fuel, labor, and steel. Those costs didn't increase by 8% today, but their revenue certainly did. That entire $6 move dropped straight into their profit margins. However, if you look at the mining stocks, many are not up by 8%. Why is there a lag? Because the general stock market is extremely anxious. The war reports from Venezuela have frightened the broader S&P 500. So general investors are selling off everything, including the mining companies. This is creating a massive gap in valuation. You have companies currently trading at just 3 times their earnings with dividend yields that are about to skyrocket. The general market hasn't done the math yet. It hasn't realized that at $78, these are no longer just mining companies. They're essentially cash printing machines. This delay is your opportunity. Typically, the metal moves first, and then the stocks play catch up a few days later when analysts finally update their projections and realize their price targets are 50% too low. If you feel like you missed the initial move in the metal, the miners are effectively still on clearance. Let's check back in with our primary indicator, Shanghai. We started this discussion by noting that Shanghai was at $84, while New York was much lower. New York rallied to $78.83 to close the distance. Did we catch them? No. We narrowed the gap from $10 down to $5, but a $5 difference is still a massive arbitrage opportunity. It means the sucking sound is still present. Metal is still migrating toward the east. The pressure hasn't been balanced yet. This indicates that $78 is not the peak. If we were at a top, the price in New York would be higher than the price in Shanghai. We would be overbought. Instead, we are still underbought relative to the physical reality in Asia. The West is still the discount bin of the world. As long as Shanghai leads, New York is mathematically required to follow. The physics of arbitrage demand it, so the industry is hoarding, the dealers are freezing, the miners are raking in cash, and China is still paying a premium. Where does this end? We are approaching the blue sky zone above $80. There is no chart history there, no resistance levels, only the collective psychology of the crowd. In part 4, the conclusion of this series, we are going to outline the endgame strategy. We will map out the price targets for the rest of the week, discuss the psychological traps of selling your position too early, and give you the final verdict on whether this is just a trade or a permanent paradigm shift. The price is accelerating. Make sure your mindset is keeping pace. We have reached the final chapter of this emergency market broadcast. We have dissected the $6 explosion that shattered the market this morning. We have looked at the gold signal warning of systemic collapse and exposed the industrial panic draining the supply chains. Now we stand at $78.83, breathing the thin air of market highs. For the better part of the last decade, silver investors have been struggling, fighting for every penny of profit. Today, you are finally winning, but winning introduces a new set of psychological hurdles. Your biggest challenge right now isn't the banks or the Federal Reserve, it is vertigo. When you see a vertical line on a price chart, your brain starts screaming at you to sell. It tells you that the price can't possibly go higher, that this is a bubble, and that you should take the money and run. In this final breakdown, I'm going to provide you with the psychological armor needed to survive the next leg of this rally. I will explain why selling your silver for paper dollars right now is the most dangerous move you could make. I will map out the targets in the blue sky zone above 80 and leave you with the final verdict on whether this is the peak or just the beginning. The ceiling has been shattered and the sky is wide open. Let's wrap this up. Technically speaking, we are entering a phase known as blue sky once we cross 80. There is no previous price history to look at. There are no resistance levels from 20 years ago. There are no bag holders who bought at higher prices waiting to sell just to break even. Every single person who owns silver right now is sitting on a profit. When a market enters blue sky, the laws of financial gravity change. The price moves faster because there is no overhead supply of people looking to sell. The only remaining resistance is purely psychological. $100 is only a barrier because it is a round number, not because there is a logical reason to sell there. This means we could see volatility expand even further. If we moved $6 today, we could easily move $10 tomorrow. Do not be intimidated by the speed of the move. Speed is simply what happens when a tightly compressed spring is released into a vacuum. The market is desperately trying to find a price that balances the global supply. Since the price in Shanghai is already $84, the books are still out of balance. We must go higher, simply to reach a state of equilibrium. Now, let's address that intense urge to sell. You see the numbers in your brokerage account climbing and you want to lock in those gains? But ask yourself, lock them into what? Into US dollars? Think about the fundamental reason silver is climbing in the first place. It is rising because the dollar is losing value against tangible assets. It is rising because the national debt is unpayable and global conflict is erupting. If you sell your silver at $78, you are trading a proven safe haven for a high-risk paper asset. You are essentially trading your spot on a lifeboat for a ticket back onto the Titanic. The smart money doesn't sell for cash during a currency crisis. They engage in swaps. They trade one undervalued asset for another. They wait for the gold to silver ratio to signal that the time is right. Currently, that ratio is 56. Historically, it bottoms out around 15. This means silver is still incredibly cheap compared to gold. It has the potential to double in value against gold, even if the price of gold never moves another cent. Do not sell for dollars. If you absolutely must move your position, swap it for gold, but even then, it is likely too early. The ratio tells us to hold the line. We also have to consider the general public. Today's 8% move will be the lead story on the evening news and will dominate social media tonight. The average person is just now realizing that silver is the top performing asset of the year. They haven't even started buying yet. They are still in the process of opening brokerage accounts or finding a local coin shop. This means the massive retail wave is still on the horizon. The true mania phase occurs when the general public goes all in. Right now, we are only in the institutional phase. The big players are buying while the public watches from the sidelines. When the masses start buying, that is when we see the jump from $80 to $150. You do not want to exit before the mania. You want to sell into it. You want to sell when your Uber driver starts giving you silver investment tips. We are nowhere near that point yet. So here is the final verdict on the Shanghai explosion. The market has fundamentally broken. The West has lost its ability to control the price because it has lost its grip on the physical metal. The East is now setting the price because they have the actual demand. This arbitrage gap is forcing a massive revaluation of the entire precious metals sector. $78 is not a speculative bubble. It is a long overdue correction to reality. The reality is that silver is rare, strategically essential, and in short supply. The paper price was a manipulated lie for 4 decades, and today, the truth finally emerged. Your strategy is straightforward. Sit tight. Ignore the short-term volatility and the intraday price swings. Keep your focus on the Shanghai price. As long as China is paying a premium, the trend remains upward. Keep your focus on the gold price. As long as gold is hitting record highs, the system is in crisis. You have positioned yourself perfectly. You own the asset that the entire world is starting to realize it needs. Do not let them shake your resolve. Do not let them trick you into an early exit. The squeeze is active, the target is in the triple digits, and we are only in the opening acts. Subscribe for more updates as this unfolds.